guys, welcome to the Capital Insider. I'm your host, Ellie Perlman, broadcasting from sunny California. If you're watching this video, it may not look like it because there are kind of tall buildings behind me. It looks like I'm in New York City, but I'm not. If I meet one of you for a discussion of why I chose California, definitely a lot of things have changed in the past decade or so. We're not going to get into it right now. I would only say that right now I'm not buying in California. I actually never bought assets in California for many reasons. And generally speaking, I tend to prefer red states. They're much more landlord friendly and they also attract a lot more people, generally speaking, a lot more tenants because they are pretty much affordable. And this could be another topic for maybe another episode. But today I wanted to talk about why I firmly believe that the GFC of multifamily is finally here. I want to talk about kind of sharing my experience, what I see running a private equity shop that buys multifamily. Can share with you why I think we're living the GFC of multifamily. Who's buying those assets? Because not all players are playing right now in a sandbox, and how you can take advantage of it, whether you are an ultra high net worth investor, whether you're a family office listening to us, or an institution, pension fund, endowment, employee, etc. Not all of you are buying right now. And I can definitely talk about who is buying and why, and who's kind of sitting on the sidelines. I think it's an extremely interesting time in real estate. It's painful for those who bought at the wrong time, but it's extremely exciting for those who are buying right now. One thing that comes to mind, Sam Zell was someone that I really looked up to, and I think that he, made the right decisions when it comes to investing. He was, disciplined and also knew when to make the move. And many times he was a contrarian, also by, personality, but he made a move when others were not making moves. And he got this title, the grave dancer. And he bought assets at a very, very low price and later sold them at a huge profit to very well-known players in the market. And so I don't want to be perceived as a grave dancer, but I will share with you the amount of pain that I see right now and the amount of opportunities that I see. I mean, this is how generational wealth is being created. This is when you lock in a buying opportunity of a century. This will not come back for many, many more years. And I think it's important to see through the noise, to cut through the noise, and to put doubt and fear aside. Because in investing, many times it's about being a contrarian, acting exactly the opposite of where the mass is going. Because the mass is always going to pay premium for for taking that approach. And if you focus on the fundamentals, I think you can find really, really interesting investments. And so, for those of you who don't know me, I'm the founder and CEO of Bullet Capital, and done about 1 billion in transactions. We only bought multifamily assets. We haven't really bought any other asset classes. And so I'm looking at, offices, for instance. Yes, the mass is actually fleeing from that asset class, has been for years. But also what changed is that the fundamentals are not there because companies, many companies did not survive in this cycle. And many of them downsized and they're working from home, or they laid off some people and they need a much more footprint. And so the fundamentals, the demand drivers are not there. And so that's an example of why it's not so bad to work with the crowd, unless you're willing to wait and be extremely patient for everything to come back, which could take 7 to 10 years for the really strong demand for offices to come back. But is just an example. Just looking at the assets that are in the market right now, we see now what many people said we would see 3 years ago. And so, but if we go back to, kind of the basics, right? When I'm thinking about the GFC, back then, 2007, 8, I was actually a young attorney. I was in the international real estate department, in Tel Aviv, and was working on really, really large transactions. And one day I got a phone call, and it was my client who said, listen, we already started the, construction project. We've spent, X amount of millions of dollars on it, because the loans always come. It's just a matter of finalizing the terms. Where do we stand? And we haven't heard from the lender in a while. So we picked up the phone. It was actually a European bank. And I remember it was a very, very strange conversation, because what I heard was, hey, we're not sure what's going on, but right now our IC, our investment committee, does not approve any loans. And that was the first time that I've heard anything like that. And they weren't willing to say much more. It was really the beginning. And so that was an indicative of what was there, what was coming, right? And so back then, during GFC, there were a tremendous amount of single family homes with a lot of borrowers that actually defaulted on those loans. I got curious and I looked at the multifamily side of it, and it was a very, very small portion. I think the report said less than 0.5% of multifamily assets that defaulted during GFC. And so it was mainly private borrowers. And when a bank has millions of those loans, they don't have the capacity nor the need or the desire to negotiate a solution with each and one of in every one of them. And so we all know what happened. We all know how that ended, but that really reset the housing market. Those who had cash, I know people who just collected homes, $100,000, $200,000 at a time, just bought it with cash, just waited a few years. Then when the market rebound, when there was a rebound, they put financing on it and took profits or sold it at a profit and kind of and made it that way. And so the difference with multifamily and commercial is that loans could be $100 million. It could be $50 million. We're talking about huge loans. We're talking about assets that host 50, 200, 500 families and individuals. And lenders in the past 3 years were working on solutions and extensions with home. Now, there were trillions of commercial real estate loans that matured between 2024 and 2026. And when they were first taken by the borrowers, borrowers were paying 3-4% floating rate. And then over a short period of time, that increased. And now when it's time for refinance, when the loans are due, the two things that are happening right now, the debt is, it still could be 5.5, maybe 6%. But the main issue is not the interest rate. The main issue is the LTV. So valuations went down, which means that any lender looking at an asset that was purchased for 90 million and now is worth on paper 60 million, and their LTV is capped at 75%, that new loan, the proceeds cannot pay the original loan. And in addition to that, many borrowers can't even pay the debt payments. And so what happens for some of them, now the loan is due and borrowers are not willing to extend the loan and they can't put new financing, or borrowers have already gotten an extension by 1 or 2 years. And now the lenders are saying, okay, this is a game over. We want our money back. And so they're forcing the borrowers to sell And it's we see it a lot in the market right now. And we see many, many assets that are in good locations. They have good bones, institutional quality, tenants pay on time, units are beautiful, amenities are refreshed, but there's still not enough income. Even at 95, 94% occupancy, there's still not enough income to pay the debt. And the lender is not willing to extend the loan. And so they're forcing them to sell. Now, let's say an asset was purchased for $50 million, and I'm just making the numbers up, right? It's very highly leveraged, but let's say 40 million was the debt and 10 million was equity. And it's a very, very simple example because usually there you need to raise more money and to invest more for capex projects, for reserves, for GP fees, etc. But let's assume this is just a very, very simple example. Now the asset is worth 38 million. With a little bit of luck for the lender, it's worth 40. So the lender is not interested in taking more of a risk. They want to clear out, take, return their principal and move on with their lives. The good lenders maintaining relationships and essentially extending those loans, but not all of them. And so we see a lot of those assets, again, they're good assets, but the lender is forcing a sale. And this is a great opportunity to buy assets at a really good base where you're buying it usually at the loan balance or below that. And that's essentially what happened because there's a kind of two forces that happen at the same time. And that's why I call the GFC of multifamily. You have debt maturing, and at the same time, asset valuations were down. Some of it was because of the increase in interest rates. Some of it was also because there's been a lot of competition, a lot of new product, new units in the market and then it essentially turned to a race to the bottom. Everyone was lowering their rents, income was down, so also asset valuation was down. And to add to that, you had an increase in expenses because of inflation, etc. The war with Iran is not helping. The tariff saga it was not helping. And so all these things created a catastrophe for many, many assets. And so that's essentially what was happening when all these forces came together and the timing to exit was essentially less than ideal to say the least. Then you have an accumulation of good assets that are offered in a market for less than what they were purchased for at the peak of 2021. And we see those assets very frequently these days. We haven't seen it 2 years ago and a year ago because everyone was holding and extending. And now when this party is over, we see assets that were purchased at a certain amount. Assets can be purchased at 75 million in 2021 and sold for 40 million today or 35 million. We see assets at 50 to 60% discount to the peak pricing. This is not something that I've seen before in multifamily, and I don't think it's something that we will see probably in the next couple of decades. This window will close as a few things will happen. That's why I think that the next 18, maybe 24 months is a buying opportunity. It's a window for buying opportunity. And so I do believe that once in the next 18 months, most of the new construction in the US will be completed and absorbed. And when I say absorbed, I mean that the new units will be rented out. So the really low pricing would increase now that a new building is 96% occupied. They don't need to offer 3 months or 2 months free. They don't need to offer $300 below the neighboring 10-year older property. And so that once that stops, then everyone starts raising their rents again. But that will take a little bit more time. We're at the tail end of it. And we know that there's no more units coming online because we know across the board how many new permits are being submitted. Not many. So that's good. And so essentially, during this time when we have all these loans that are coming due, this is a pain, this is a temporary pain and a time in that cycle that is the right time to move and buy those assets. And if you think about it, generational wealth was not created when families bought at the top of the market or when they bought something that everyone else bought. It has been made historically, consistently, when families, really smart individuals, made their move when others were fearful, when others were hesitant. As long as, again, the fundamentals are there. And fundamentals are definitely there. And I think I've said it before that homeownership is unaffordable. The affordability gap is getting worse by the year. You have more and more people that delay the age that they choose to get married and have kids, which is when people buy homes. And the construction phase is kind of going down and new starts are going down, absorption is higher. And all these things are showing that the fundamentals are solid. And so this is kind of looking at the supply wave, and hopefully also with AI that would help reduce expenses. And that means in the next 18 months, as supply goes down and rents are going to start going up, then valuations will go up because income will go. And at that point, those who would feel comfortable investing again will buy assets at a premium because now valuations have gone up. So that's why I believe we're experiencing right now the GFC of multifamily. Something that a lot of funds have been sitting on dry powder, waiting for those opportunities. And now we finally see those coming to market, which, as you can probably see from, hear from my voice or see if you're watching this on YouTube, is extremely exciting because this is how opportunities look like. They don't come that often. And when they do come, sometimes they look messy. They look, I wouldn't say scary. I don't really use the word scary, but they look not as clean as you would have expected. But this is how generational wealth and true wealth is being made. So who's buying now? And that's pretty interesting because those with more entrepreneurial spirit and more sophistication and experience investing in real estate are the ones that are extremely active right now. The other day, I was sitting in New York City a couple of weeks ago with our CIO, and we met with a very large family office. And their minimum check was around, and I talked about that on the podcast before, 45, $50 million. So they're pretty big players. And they're making the move right now and they're buying assets at a discount. This is a family that has built a significant amount of wealth over several generations. And their wealth is not just concentrated in the US, it's international, global, across continents. They're not afraid of declining rates because they know they're buying the pain right now, but that is good. They see the signs and they believe in that asset class and they know that this will change. Also, the more sophisticated high net worth are buying those who have been through a few cycles and understand that we're essentially now part of a cycle that will be rewarding for those who are making the move now. Those who only started investing in the last decade and only started when real estate was generating 7 to 9% cash on cash on a yearly basis, which is very highly unusual for real estate. And we're going through this for the first time. They're experiencing capital calls. Some of the assets are actually being lost, pause distributions, all these things. They're not investing anymore. Some of them feel that this is not a risk that they're willing to take anymore. Some of them feel confused or scared. Those investors are not investing. And then on the other side of the spectrum, you think of high net worth on one side and family office is kind of in between. The other investor type would be institutions. And with institutions, it's really interesting because some of them are definitely allocating to multifamily investing, but big portion of them are on a sideline. They've been allocating a lot to multifamily in the last 5 years, 7 years, and they're experiencing some pain with their current portfolio because the current pain has not skipped anybody, not the bigger players, the smaller players, the mid market players. Everyone was going through this. And they essentially, some of them are not really making any moves with multifamily right now. They want to still see how their vintage, how the assets that they've bought in the last 3 years would turn out. If they will be able to save some of that money by exiting at the right time. They're also capturing some losses right now. So for them, it's a little bit more, it's a little bit harder to invest in something that has given you some hit. And they can understand and they agree with the fact that this is an interesting window of opportunity, but they also have governance and investment committees, et cetera, that they need to report to. And so the risk profile and risk tolerance is much different than family offices and more sophisticated capital. Not more sophisticated than institutions, but more sophisticated than high net worth, which just started, let's say, in the last 10 years or so. And so it's really interesting to see that. And it's really possible that those who are not comfortable investing now would decide to make the move once multifamily is a little bit more, it's back to being mainstream, meaning rents are going up, cash flow is more substantial, and distributions are on time. But then they're probably going to be paying a premium for that. The premium and risk are two things that are forever going to be combined. Unless you're very lucky, they're forever going to be combined. So many times, those who are buying right now are not the same people or not the same groups that were buying in 2021. I know a family office that I can't really disclose their name because they're very well known. They have stores all over the US, and they were selling 100% of their multifamily holdings in 2021, 2022. They thought that the market was over valued, and they sold it to multiple sponsors and multiple groups with the intention of going back and maybe even buying the same assets from them at a discount. That was when I spoke to them back then, 4 years ago. That was their plan. It would be interesting to go back and see if they're actually buying now at a discount. But I would say they were the outliers. Most of us did not have that foresight. So that was pretty interesting. Now, when you're listening right now and you're asking yourself, okay, I understand what you're saying, Ellie, but how can I take advantage of it now? So I would say the first and foremost, the window, back then, with GFC, it ended what, 2011, 2012. First of all, you got to understand this window is not going to last forever, right? So once rates stabilize and supply is going to come to a complete halt and all the distress is cleared, pricing will recover. This is just that's the cyclicality nature of real estate. So just understand that. That's first and foremost. This is not going to stay here forever. Now, when you're looking at assets, I would very much, and I talked about it before, I would focus on the basis, not the yield. Forget about 11% IRR, 15% IRR, 17% IRR. It's an important metric, but not as important as the basis. How much are you paying per door? Someone bought it for, $350,000 a door and you're buying it at 380. That's not, it depends on the market. Boston, for instance, is kind of its own beast, in New York as well. But when you're buying it at sub $200,000 and the asset could not trade as low unless you date it back to, early 2000 or the 90s, that's a great sign. So focus on the basics, because this is how you make money. It's very, very hard to make money or save your capital if you bought it at the wrong price and you can't exit to cover that price, that basic. The other thing that I would say is when you're looking at deals, whether you buy on your own or you're part of a deal when there are sponsors and other operators, I would highly recommend to target distressed debt asset, not really distressed operations, unless you trust the sponsor and they know how to manage distressed assets or you have the team to do it. Distress above the line with operations that is failing, it's really hard to clean up and manage. But loan extensions that failed or did not come, and the asset is fine, the area is fine, the tenant base is solid, but the debt matures, that's an external factor to the asset itself. This is the type of distress that we like at Blue Lake. So I would focus on those and also on markets where you have supply that is being absorbed. So we all know that DFW has a lot of supply, same as Atlanta, but those markets are absorbing units because there's more and more people that move to those markets. So the new units that are being delivered in the market are being absorbed and being rented out. These are good markets to invest in. Phoenix, for instance, I would be a bit more careful because they're still, I think maybe we're 2 or 3 years out of supply being absorbed because the amount of units delivered is so significant and there's still a lot more in the pipeline. It's going to take more time than other markets. So definitely would look into that as well as the bases. And then be prepared to 5 to 7 years. This is, hold. This is real estate. I still hear some people that are thinking about 3 years. It's just too short. Real estate is a long-term game. 3 years, it's on a flip. It's not a single family home flip. It does take time. I would say our minimum is 5 years. And I would say 5 to 7, that sounds better than 3 years. So I would definitely look into the bases, look into distress that comes from the loan, not from the operation, and be prepared for kind of a longer hold. This is true, real estate, and the past decade has been really good to multifamily. Well, with the exception of the last 3 years that were challenging, but there was a good decade in challenging 3 years. And now it's a really, really interesting buying opportunity, which I think is exciting. So, if you're still sitting on the sidelines, I totally get it. What I'm just saying is that if you strip that away, the fear, and look at the fundamentals and look at the pricing and look at those who are making moves. These are the same groups, the same families that have built generational wealth that spans over, continents. They're all doing the same thing. They're all buying when others are avoiding doing this. So, and then they will turn around and sell it to them when everyone is comfortable going back to that asset class. I know it sounds, I may be simplifying that. It sounds easy. It's not, but this is what we've seen. This is how I see it. This is my, I would say, second cycle. The first one was, well, I was an attorney. So I experienced that through my clients, and the second one was now. And so there's definitely things that are shared between those cycles. And if you want to understand how Blue Lake looks at markets, how we underwrite deals, and how we value opportunities, you can definitely go and check out our website. All the links are going to be in the show notes. This again, if there's one thing I want you to remember from today's episode is that look at the base, always at the base. Price at the door. That's the first thing you need to look at. And that would lead you to the right conclusions whether to buy certain assets or not. That's it for today, guys. Thank you for listening. And again, I'm Ellie Perlman from Blue Lake Capital. If you want to reach out to us and have a chat, you can find it on our website. You can Google us, or you can reach out through one of the links in the show notes. All right. Take care, guys. Bye-bye.